Lloyd, I decided to save a few trees and print out only 18 pages of the 361 pages in your most recent report, in which you put a sell on Noble. Does this deal change your view?
Good morning. No, it's actually a surprise. Most investors thought that Noble had the assets to continue to reinvest and grow going forward, and that we put out a note the other day about feedback we've gotten, and most of the pushback was on Noble, where investors were very comfortable with what they had going forward. Our concern was that what investors would pay for their asset in Israel going forward. So the fact that they went out and bought a producer and paid a 38% premium in today's market, I think, is going to be taken as a surprise.
What's your thought on this fracking debate? David Einhorn came out so against frackers. Even Boone Pickens is sort of in agreement with David, but not necessarily on the timing.
Yeah, I guess I haven't actually had time to go through David's analysis of it. It certainly struck a nerve. E&P companies typically are accosted for having poor return on capital and poor investments. I would argue, though, that in this case, the core of the shales are good investments. And what you're going to find is, I would have thought he could have made the argument a year ago and pointed out that some of the plays aren't good investments. And what the market is actually doing is sorting that out right now. They're saying, hey, something like the Mississippi Lime or the Tuscaloosa Marine Shale is not a good investment. But the core of the Bakken, the core of the Permian that he went after, I would argue, is actually going to turn out to be a pretty good investment. And one of the keys to that going forward is going to be technology. And these new advances in technology, you're starting to see people like EOG Resources talk about 20 to 30% more out of the reservoir for very little incremental cost. So I think that's probably the argument against.
And in the meantime, oilfield services are costing a whole lot less.
That's right. That's right. That's a really good point. In the recent quarter, what you've seen is costs are coming down 20%, and they expect another 10% going forward. And about 50% of that is secular versus cyclical. So you're seeing costs come down, you're seeing technology improvements go forward, and you're very early in understanding what fracking's doing. You're getting about 8 barrels out of every 100 out of the ground right now. And as this new technology starts to take hold, that incremental barrel is going to be the highest return barrel.
So a year from now, Lloyd, what do you think? Let's just take the Permian Basin, West Texas, as an example. What is it going to cost to get oil out of the ground there?
Well, I think people have talked about $20 as kind of a finding and development cost going forward. I think you're going to see that come down probably 15 to 20%. Secularly. So you can be in the $15 range, probably.
And companies that you have a buy rating on, when are we going to see those prices improve? Timing?
The stocks or the oil, I'm sorry?
The stocks.
The stocks. Well, you've seen a good run in these stocks. The direction of oil drives relative performance in the stocks. And one of the big debates you have going on right now is the portfolio manager analyst debate, where the portfolio manager is saying, hey, you know what? We found a bottom in oil. It's starting to really move. I need to get into this thing.
All right, Lloyd, thank you so much for joining us. Lloyd Byrne, Nomura Securities, Head of Energy Research.